Today we are with Steve Bennett from Demex, and we're just going to have a conversation about parametrics, the future of parametric products, innovation, what we see on the market, what the future holds for us. Steve, we've met for, I don't know, a year now, and we both have a background in the weather derivative space. Is that correct?
That's right. Yeah, I was actually back at Enron in the late '90s when weather derivatives were spinning up. So it goes back quite a ways.
I went into the derivative space close to a decade now, and it is surprising how this segment has moved on over the last couple of years.
Yeah, it seems like there's been a lot of growth, especially over the last probably 2 to 5 years or so, I'd say. And I think the traditional weather derivatives market has kind of been in a solid, steady state since the early 2000s up until the last couple of years. And I think a couple of things have changed, at least that I've observed, have changed over the last few years. One being just the sensitivity to resilience. So some people use the term climate resilience. Typically, in my mind, it often means resilience to weather events. And there's really been an appetite over the last several years and a knowledge base that's let us focus on the types of risks that are not catastrophic in nature, because those have been well covered for many, many years with well-established parties in the marketplace. But there's a category of risk that's much higher frequency but lower impact. So catastrophes, low frequency, high impact. And I think just the understanding that the financial sector, number one, but then all the way down to the sort of to the end business, whether they be large businesses or small businesses, can become resilient to those everyday weather events that affect either their revenue or their costs.
At Demex, exactly what is it that you do with all this data and the capability to deploy it on a granular level, but yet covering the entire globe with these data sets?
Yeah, so at Demex, our core is the technology platform at the center of our business. So we use that to leverage these very large global data sets and to allow our customers, both on the risk carrier side and on the broker's side, all the way down to the end risk holder, so the business that has the risk to start with, and we provide 3 primary sets of ways through our platform to transfer risk. So one is what we'll call just sort of a standard product, which is we take variables such as snowfall, temperature, rainfall, and we will provide priced covers for any location on the globe, essentially, at a 1 in 5, 1 in 10, 1 in 20 year return period. So essentially, a broker can come onto the platform, understand that broker may work with a portfolio of golf courses or construction sites, be able to find particular properties of interest for that broker, and see a pre-priced portfolio of protection. So if it's a golf course, it may be a high rainfall event that where the course itself suffers some flood damage. And again, we're talking non-catastrophic, right? So we're talking a 1 in 5 year event, a 1 in 10 year event.
So the more traditional weather product, right?
Yeah, so definitely in the space of a more traditional weather product. So, where a high rainfall event on a given day may wash sand out of a sand trap, or may cause some damage to a couple of greens on the course. So it's not a catastrophic loss, but there is an increase in cost for landscaping. Somebody's got to go back out and fix that stuff. So the idea would be for a broker to be able to very quickly, within a minute or two, be able to come find a property, be able to see a set of pre-priced protections for 1 in 5, 1 in 10, 1 in 20. So that's the sort of standard set of products. And the idea there is just speed and efficiency of being able to get a rough price or to get a transactable price on the risk. We also do a set of what we call a calibrated product, which is where we're working with, in those instances, we're often working with the end risk holder themselves. And this is really the foundation of our business as we came out of Munich Re, where we will look at for property management firms that may manage hundreds or thousands of properties, where they're responsible for contracting for snow removal, snow and ice removal across those properties. What we're able to do is, on our platform, we can take in every individual property itself, so down to the street address, essentially. We will then take the relevant weather data, so snowfall data, at those locations, and then calibrate that to the customer's cost curves. So a snowplow contract in the suburbs of Boston may have a very different financial structure to it than one in the downtown Washington, D.C. So we basically take in each of those cost curves from the contracts themselves, from the snow removal contracts, and then calibrate a parametric model across the cost data, so the 5-10 years of budget data that the customer brings to the table. So how much have they paid to remove snow over the last however long they have data. We then calibrate all of that together so that the parametric becomes a fully calibrated model to their expense, to their snow removal expense.
These are fairly sophisticated financial engineering structures mixed with the weather element. Now, how are you looking to reach beyond, the traditional business that Demex and before when you were at Munich Re, and now try to scale that up in other geographies with maybe the level of sophistication of the counterparts is not as specific, but require solutions that are on the easier side to understand, but the implementation of which is much more difficult.
Yes. So a couple of directions there. One is the concept of embedded microproducts. So the ability to work with an insurance company essentially on smaller protections over a wide portfolio where they're already providing some sort of some form of business lines or PNC or other types of basic that they already have the customer in line. And what you're looking for there, it would be to provide a level of coverage that helps to offset a deductible or helps to strengthen the brand of the insurer by allowing for a parametric cover that is basically baked into the underlying policy, where when something like what happened in Texas earlier this year occurs, there's an additional level of protection. I mean, we already know that the policy is going to pay the bulk of that, but the policy holder is often subject to unexpected or expected upfront fees. So we think parametrics can be a help there, and that would be at scale. The other place that we've been focused is, as you know, has been thinking about risk transfer globally in parts of the world where the markets may not be quite as mature, and the platform that we've developed will empower anyone in the network. So important to note that the technology is our core offering, and what we're trying to do is facilitate the transaction. So we are as open as we can be for users to come in and use the technology to analyze and price transactions that then will sync up the risk carrier to the holder. And I think that's where we've had the opportunity to work together over the course of the last several months.
So use technology to reduce the friction of transaction in these locations where, as you mentioned, the markets might not be as developed or the offering is not as sophisticated, and as a way of facilitating once again the flow of capital and try to take the sting out of these events that you say 1 in 5, 1 in 10, 1 in 15, which are not catastrophic, yet they bring significant disruption to the end client.
Are there any markets specifically that you've observed where these types of innovations might be quickest to reduce some of this friction?
The great example, I think, is the agricultural sector, because even as old as agriculture is, agriculture is an early adopter of technology. It might sound counterintuitive, but the knowledge that the farmers have mixed with a little bit of technology is a great tool. And I think in many areas of the globe, even the most basic agriculture is starting to rely more and more on technology to make decisions. And I think the speed of facilitating that decision making and the increase in information available to those decision makers will be the point that will make the implementation of these kind of covers a lot faster, because they understand very clearly what a drought means. They understand very clearly that if the rains haven't showed up when they normally expect them to show up, then there's going to be trouble. But with the advance of technology, if you can provide them with the information to say, well, yes, the rains have not showed up, but there's still enough moisture in the ground so you can plant now, and potentially the rains will come out at a specific time. If that doesn't happen, then you're going to have a product that is going to at least provide you with enough capital to survive this season and be ready for next. Or you can take alternative decisions, or like put aside business, or making that kind of decisions that will take, again, the sting out of these events and in the end build resilience, which I think is the ultimate goal of all of this.
Totally agree. And I think the appetite for the investment appetite, so the upstream appetite for this kind of investment, essentially, so putting capital in to these sorts of programs to create the financial safeguard, that appetite's been around for a while, right? I think we've seen that 5 or 10 years with a real push. So I think the key now is helping the end user, and in the case you just gave in agriculture, it's it's probably down to the farm level, right, of helping those individuals or those businesses understand that these kinds of protections are available, what data sets they use, what data sets they could blend together to use, because we are getting much higher resolution field and soil level data, but we don't have long histories of that data. So if you want to put a parametric cover around something that leverages those micro level observations, you have to do something to build the pricing set or the longer history.
And I think the approach that we at Global Parametrics are taking takes a little bit of the sting of that conundrum, because we're trying to work with the aggregators in order to reduce the notion of the basis risk associated with going in the last mile. So I think in that way, you're reducing the level of the transactional cost, but you're also leveraging the access that the aggregators have to distribute a product in a much more efficient way without having to specifically design one parametric product for a half a plot that probably is now impossible with the technology that we have right now. But then again, 5 years ago, we would have said that having a 5 kilometer grid for weather data was not attainable.
Right, and I think the thing that you brought up there that I think is a critical part of this ecosystem, you mentioned the aggregator. This marketplace has always had a number of intermediaries in it, and I think one of the keys that I see in this space is there are a number of new entrants to this space that are looking to disintermediate. They're looking to try to make a better direct connections, between the risk holder and the risk taker. I think this market needs the intermediators or the aggregators, right? Those individuals often bring a level of expertise that cannot be automated away. And I think market growth will happen more quickly and more efficiently if we empower the intermediaries with tools that help them leverage their expertise, increase their deal flow, essentially. So be able to increase the pace of the transaction so that they could do more transactions, give them more information so that they can build their own domain expertise to build their relationship with their end customers on the downstream side. So I think that level is key. Like I think that the intermediaries in this marketplace are experts in their own right.
Yeah.
And I think they're critical for this market.
Looking 5-10 years ahead, where do you think this new push for the implementation of parametric solutions and the health technologies is bringing into massifying the access of these kind of solutions? How do you think it will impact not only the risk transfer product, the risk transfer market, but also the resilience on the communities that do need this the most?
I think the 10-year horizon, the 5 to 10-year horizon, basically, I guess I'd use the term democratizes these devices, right? So I'm sure you remember, and probably a lot of people who are listening to this remember the early days of the Climate Corporation, in the early 2000s, and the original mandate there was, to the business by business, to the Main Street business, is really where their thesis started of providing a level of weather protection that might be for an ice cream shop or a coffee shop or something like that, that knows that their business differs if the weather's hot versus if the weather is cold. And the timing there wasn't right because the data wasn't available. It was too hard. Essentially, you had to build up these enormous, the models just hadn't been built yet to a point where you could service that level. And I think in the next 5 or 10 years, what we're going to see is number one, there's a huge opportunity for the insurers themselves to offer a higher class of service to their existing customers. You won't have to build a new market. The market is already there. The insurers will begin to seize onto the technology to be able to provide that additional level of service to their existing customers and to try to acquire new customers away from the companies that will be slower to innovate. So I think the technology that we're seeing now is going to empower this level of protection at on a wide scale of property owners, business owners, and then of course also the technology will be such, and the capital rates will be such that then the next level of protection can be more societally at large, right? And I think
Absolutely.
that might be where I turn the question back around to you, which is to say that for vulnerable populations, how this kind of I can see it from a business perspective, and I think from property owners to business owners, I can see how this expands very quickly. And I think one of the ways insurance complex, the risk carriers that are already protecting those customers. I also believe that there will be a follow-on effect societally, and I think you may be better positioned to speak to that than me.
You're talking with your experience of a fairly developed market, and we're looking outwards to emerging economies and where these solutions are not known and difficult to implement. But I think the key in all of this, we've gone through the data set, the computational power, the aggregators, but I think technology is going to be the grand difference maker in all this story. And I think we can draw a certain parallel in terms of the technological leap that you saw with mobile technology and the cell phones. That I'm from Venezuela, and when I first moved to the US back in 2000, I was appalled to see that this mobile phone service in Venezuela was better than it was in the US. But in the US, it was technology that was 15, 20 years older. In Venezuela, it was brand new. So, and that same happened in Africa, for example, where you leapfrog generations of mobile technology, and you went from 1G to 4G, to give an example. I think that would be the key to unlocking the real benefit of using parametric solutions to mitigate the impact of these events and build resilience.
And I think that's the resilience piece is key. And I think the more scale we obtain in placing these programs and these products, the ability to be resilient, meaning recover. So number one, either the way I see it, there's sort of two thought processes that you can work down when we're thinking about resilience. So there may be, in some instances, the economics of the situation will make mitigation the primary, will be the best investment, essentially. So, and that mitigation / adaptation. So, those could be large capital projects, right? Because what's happening is there's a well-defined thing happening. So there's a well-defined trend in a particular variable: snowfall, temperature, rainfall, whatever. Let's just use the example of rainfall. So let's take an area where there's a well-defined trend in rainfall upwards. So it's getting wetter, and it's reliably getting wetter year over year over year. In the areas where that is occurring, those may be well suited for large-scale capital investments to mitigate the impact of heavy rainfall on the environment, in my view, it's on the business or on the property or whatever. There will be other areas that may have an upward trend in rainfall, so they're also getting wetter, and extreme rainfall events are becoming more frequent, but they're not becoming reliably more frequent. So the 1 in 10 year event is going up quite a bit. The 1 in 5 year event is going up quite a bit, but you have a lot of year to year volatility.
Yeah.
In those instances, large scale capital projects may not be the best mechanism to provide resilience. In those instances, it could be a risk transfer device where you understand that you're going to suffer some financial loss because of this degree of variability, but you know that in those years where you suffer that loss, you're going to be made whole financially. And so basically you just recover from it. You just, you get your protection, you receive your financial protection, and you use that to then build back whatever the loss was.
So it will be taking a trader's view of risk and volatility.
To smooth it out,
Yeah,
exactly.
excellent. And again, I think technology will be key to that. And I think at Demex, you guys are doing a fantastic job on making that technology available and useful for the implementation of these programs.